So Happy New Year. Happy and hopefully healthy New Year to all the attendees. We have a very good audience today. So a shout out to clients Blue Heron has worked with for a long time. A shout out to Northrop Grumman Federal Credit Union. We will soon be celebrating our 22nd year anniversary serving Northrop Grumman employees. I just had a review yesterday with a client I've worked with for 30 years. So as you add all those numbers up, there is a lot of experience coming from the Blue Heron Financial Group. I am Margie Cosmerl. I am president of Blue Heron Financial, and typically you would see the other advisor, Liz David, here with me. However, Liz is on maternity leave. So we're delighted to announce that she had a baby girl at the end of 2021, and she'll be back in the seat here before too long. So again, hopefully this finds you all doing well. And I love that we've got a takeaway here. So as I make my way through the presentation, your takeaway here with reference to passing the baton, to just kind of file that away and refer back, oh, right, what was that all about? And passing the baton is referring to this shift that we are now in the midst of. Today's presentation, I will be referring back to 2020 quite a bit because it has been such a pronounced time in our history, financially and otherwise. So passing of the baton, well, the Olympics are coming up, but I don't think we see track and field in the Winter Olympics, so that's not the reference here. The passing the baton is referring to this shift, as I mentioned, from the support from fiscal and monetary policy out to what typically carries our economy, and that is to all of us as consumers, to small business. That is what keeps our economies moving forward. After all, the consumer is 2/3 of our huge US economy. So I'm going to take time on these different slides. I'm going to spend time talking about stocks, bonds, economy, and because we are being recorded and because compliance requires us not to take live questions, at the very end, you will have a slide with contact information. Feel free to email any questions that you may have to Debbie, and she will get those out to myself and to the other advisors here at Blue Heron. So without further delay, let's just jump in and talk about the economy. And the caption here, from hand up to hand off, I know after talking to many of you over these last couple of years, some may even refer to it as hand out. However we want to look at this, there has been unprecedented stimulus that has come from our government as we went through an unprecedented time, a 100-year pandemic, the shutting down of our economy. And what transpired since the depths of the despair of those early days, I think we can all put ourselves back there. I called it the Friday the 13th. Everyone here at Blue Heron, grab your laptops, forward the phones. I'm sure we'll be back in the office in short order. As we all know, that's just not what happened. However, what did happen really, again, was extraordinary. Yes, there was fiscal stimulus. Yes, we had a very accommodative Fed, which I'll speak to a bit more as we move along. But it was the combination of all the above that really kept us forging ahead. That market hit that wall in March. It took that deep dive. And yet, once that turned around, after the shortest recession in history, it moved forward. Our economy moved forward like nobody's business. Again, we'll look at some numbers in just a second. So demand is still strong, and again, big takeaway here is we are still constructive on the market despite what's taking place this week. So clearly we are seeing, in my opinion, an overdue correction, and it's okay. I pull lots of Wall Street adages out, and one of my, I've got a lot of favorites, but one of those is the trees do not grow to the sky. It's okay to prune the bushes, so to speak. It's okay, and it is normal for the markets to retract before they forge ahead. So yes, I'm fully aware. S&P 500, we're hitting that 10% downturn. NASDAQ in excess of that. The Russell 2000, small caps in excess of that. However, we are still, again, looking for a growing economy this year, and in turn, for the stock market to prevail. Let's put some numbers behind it. In 2021, again, 2020, we had a retracting economy to the tune of 3.8. And yet in 2021, not only did we make up that 3.8, we exceeded it with this 5.5% GDP. These are strong numbers, folks. When we go back, and we've been doing our outlooks for many, many years, and the US economy, as big as it is, if we saw a good 2.5% GDP, or we're forecasting that, that would be an okay year. But again, this just really drives home the point that our economy was resilient, and really was moving forward last year. So expectations for 2022, you will see that come down a bit. It's okay. We were in strong recovery mode. However, you're going to hear me say these terms probably multiple times today. And one of those is mid-cycle. We're going to talk about a lot of mid-cycle, mid-terms. So if indeed we are mid-cycle, as we believe we are, it would be an expectation of ours to look back in 2022 and expect to see our growth in this 4 to 4.5% range. Let's look outside the US. Developed ex-US, we're talking about, think in terms of Europe. They had a tougher time making their way through COVID. They had more restrictions, and it just did not lend to as strong. However, it still was strong. So looking at 2021, 4.6, nothing to sneeze at. And then looking forward in 2022, still a growing economy. Emerging markets tends to be an area that we have only intermittently participated with regards to our asset allocation, because we just feel at this juncture, for most, not all, of our clients, the additional volatility is not warranted. That being said, the strongest of the economies, but we also have to consider that China's in the mix in there, and whether we're getting actual data is part of it, but also the fact that they've got a lot of restrictions going on. So expectation there, again, still moving forward, but really more ex-China, I would say, at this point. However, overall, a global economy that is growing, moving forward, and prospering. All right, let's talk about the I word. And I will, again, here's another term. We're going to talk inflation, and is it the boogeyman in the closet? And let's look at some of these numbers and look back at history. So I'll get more into the details on that. But in terms of forecast, here's what we were looking at for 2021. And again, we can measure this by CPI, CPE. I've got a chart on that coming up. And in 2022, you will see that our expectation is that inflation will start to subside to some extent. The big transitory word that we kept hearing time and time again through 2021, and I was here in the office saying, I don't think so. Let's think about what has transpired in terms of stimulus and the money that has been pushed out and demand for items. And that just goes back to too much money, chasing too few goods. What is that a recipe for? And then we get our inflation. So, but this is indeed a period where we don't think it's necessarily going to stick at the levels that we have seen. So here you will see forecasting of inflation between that 3 and 4%. Here at Blue Heron, just as a side for those who don't know us or don't know us well, we start with the interactions with those we serve with planning. Everything has to start with planning. We need to know what is important to the clients we serve, and whether that is, can I retire, and can I buy that second home, and all those questions. We have to start with facts and certain assumptions. So at Blue Heron, we have been assuming inflation into our planning of 3% for quite some time. That is our historic number. Now, through really the last 2 decades, that has been more in line with 2%. So we feel that here again at Blue Heron, using 3%, that we padded that a bit, but we'd rather err in that direction. Unemployment. It is a tight labor market right now, but it's just kind of it's a mixed bag. We all see the signs out there, help wanted. We know that the jobs are out there, but people have not been real quick, and there's a lot of theories on that, which I'm really not going to get into. But the point being is that we should see more of those jobs taken in and the unemployment rate drop. The last figure you're looking at on this particular slide is the 10-year Treasury. Now, this is important, and this is where I get a little bit geeky, if you will, and we're going to get a little deeper into bonds in just a bit. So through 2021, that 10-year Treasury, it's a big barometer. It was languishing in that 150, pushing up against 175, and looking into 2022, we think that 175. It's actually here right now, and largely due to volatility. So let's assume that's where we are. We're at 175. And we certainly are expecting that we'll see that bump up, but not bump up so dramatically. And that is really important here. Just because we're talking about a rising interest rate environment does not mean that all of a sudden rates go up, markets go down, and we're headed into a recession. We do not foresee a recession in 2022. All right, so let me just make sure I've cited what I wanted to cite here. I think we're good on that. I mentioned this before. I'm going to speak to the CPI inflation. However, please know that PCE inflation is what the Federal Reserve is looking at, as well as CPI. As we look at this chart, again, I've got some tenure here in this industry. Not saying I was in here back in the late 70s and early 80s, just putting that out there. But I do remember it. I was a young adult, and car loans, double digits, mortgages, double digits. Sometimes I would hear our older clients say, and my CDs were paying 18%. My response was, yeah, but what was inflation then? So the borrowing costs were exorbitant. That is not what our expectation is. So as you move along here, you'll see the CPI is more volatile than the PCE inflation. But over to the far right of the screen, this is what transpired over this past year. This is what Social Security increase, Social Security benefit increases were based upon, the 6% increase that you saw. But keep in mind, Medicare also went up. So you're not seeing all of that in your pocket. All right. So let's get into some discussion about stocks. As I said, markets are, you can call them anything you want to. We'll just stick with volatile right now. And I think it's, again, so important to think about 2021, which was really a straight up shot. We saw one little minor 5% pullback. Maybe you remember your September statements was the first down, or slightly negative than the statement, the quarterly statement before June of 2021 or March of 2021 or the end of December 2020. And it was only 5% as measured by the S&P 500 in a diversified portfolio, of which certainly any clients that we're working with have. You were not all in that downturn. That's where diversification is so important. We always want to have different levers to pull depending on the climate. So when we think into 2022, into this mid-cycle, we're going to look at a slide in just a second, we are continuing to think along the lines that despite the volatility that is expected, that we are seeing right now, that we're going to look back on 2022 and we're going to see some decent returns. So when we think about stocks, what drives stocks? Well, some of it is one of my favorite subjects, and that's good old behavioral finance. But when we get into the nitty-gritty, it's earnings, it's corporate earnings that drive stock behavior. So back to the forecast. And this information is gleaned from our broker-dealer, LPL Financial. For, again, those who don't know us, we are independent. While we are associated with LPL Financial, we glean our information from many different financial institutions. So as we go through the slides, we've got a deep bench with LPL research, but that is not the only area that we're looking at research from. We're looking at a lot of other houses and then forming our opinions here at Blue Heron. So back to the slide that we're looking at, are looking ahead, again, despite the ups and downs that are already occurring and is normal market behavior, that at the end of the year, we might be looking at this nice round number of 5,000 on the S&P 500. Now, before today's presentation started, we were around 4,300 and change. That's off of a high of 4,800 and change. Thus the 10% correction that has already happened. Now to go forward to 5,000, again, not to put all of this into the numbers, but that comes into what an expectation for mid-cycle economy returns on stocks are. So this 5,000, 5,100 is not, I use the term pie in the sky. It can be realistic. So this is, again, back to this mid-cycle. Last year, that really strong recovery, and I don't want to get too stuck on S&P 500, but it is our go-to barometer. No one, again, under our management, unless it's a super young investor, would not be 100% invested in the S&P 500. And that's really important. As you turn on the news, you flip over or turn on your phone and you see that in 2021, the S&P 500 provided almost a 27% return. We are not 100% invested there. We participated, absolutely. We had positions that were hitting those kind of numbers, but we wouldn't want to be all there. And this past week is a good reminder of that. So back to the slide, what you're looking at, and I do think that these numbers hopefully will just kind of soften some of the angst that may be there considering the downturn that we're in the midst of. That part's normal, as I said. What's abnormal was only a 5% correction last year. But as we look at mid-cycle, not right out of the gate, we already did that last year, strong recovery, strong economic growth, but mid-cycle, which can last for several years, in 80% of those mid-cycle years, the average gain was 11.5%. Fully aware, we can have negatives on the other side and positives in excess, but that's a nice number to be thinking, okay, the stock side of my portfolio, as measured by S&P, we could be looking at some decent gains here. There were some outliers back in 66 and 77 where there were some negatives there, but by and large, you're going to see those mid-cycle returns right there in that 5 to 15% range with this 11.5%. There's always the disclaimer, you'll see there, past performance, no guarantee of future results. I'd be remiss and non-compliant if I didn't point that out. All right, so we are likely, it is our expectation, largely, as financial advisors all across, economists all across, that we are going to see not one, but likely a couple rate hikes this year. And by tomorrow afternoon, well, actually, it'll probably be more into next week, as we get the Fed minutes revealed, then that will lend to what our expectations really should be in terms of timing for an interest rate increase. The chart that you're looking at here is giving us numerous first rate hikes and then the period of time leading up to these first rate hikes. You've got a 9 out of 9, a 100% positive return for that year leading up to the first rate hike. So some of this is looking in the rearview mirror, I get that, but I think it's also really important to remember, just because we're getting a rate hike doesn't mean it's all gonna just, fall off a cliff. The Fed is not going to be raising rates if they don't see strength in our economy. That they don't want to be responsible for pushing us into the R word, recession. So again, take this with a grain of salt, but you are seeing strength leading up to that first rate hike. And even afterwards, it's the stats are something like 7 out of those 9 are positive as well. We're going to look a little closer at that in just a minute. Let me just make sure there wasn't something else there. Well, this is important. I keep referring to mid-cycle, and I also made reference to midterms. And as we know, and many of you are probably on this call because you're seeing the markets being a little crazy right now. Number one, we always want to take a long-term view. I know that's hard when the news is coming at you fast and furious, and you've got the naysayers and the world's going to come to an end. We've got to tune out the noise. We've got to get back to the basics, and we have to think in terms of long term. All that being said, expect that we will see not only just this, and I'm not minimizing a 10% or 15% as it may be for the NASDAQ. It is normal to see in a midterm year a 17% pullback. We're in midterm elections coming up in November. However, when we think about what transpires oftentimes through those midterm elections is that where we may have politics leaning really heavily in one direction, they get back to a mixed, could be, you know, however it is. We've got our Democrat president and right now 100% on that side. But if, as is historically the case, not making a political statement here, I assure you, that the House does lose seats, that the House does change in terms of the majority, and then politics are back in gridlock, and that actually tends to bode pretty well for the markets. All right, we talked about earnings. I'm not going to spend too much more time here. I think, again, as you can see, we're looking for continued increases. Now, I'm not going to paint this rosy picture like it's a walk in the park. There are headwinds. Headwinds, well, inflation, wage pressures, taxes, that definitely could put some pressure on what our expectations are for this year. So by no means, not being Pollyanna here. However, we do think, based on what we're seeing and the likelihood of our economy to continue opening up, that this can be realistic in terms of earnings, which should translate over to, again, that 5,000 mark that we just took a look at. All right, bonds. I can't believe I'm going to say this, but I am going to. Bonds are actually one of my favorite topics this year, maybe because they've just been kind of out there. In our profession, we have the privilege of getting in front of more Zoom over the last 2 years than in person, but listening to economists or stock fund managers, bond fund managers, it's always that fixed income, aka bond manager, that could kind of put you to sleep. Bonds are not really exciting, but they're kind of quasi-exciting right now because we're in an environment that we have not seen for some time. I can think back to 1994. I do remember that rising interest rate environment. I do remember that the bonds in our portfolio actually went negative. That wasn't supposed to happen. So again, as is in life, you know, that experience lends over the course of time. We went through that period, and guess what? It came out okay. So let's think about what is going on right now. You've got the VIX, which is the volatility index, bumping up to a level we haven't seen since fall of 2020. We came out of, again, that recessionary period, and the volatility spiked in November 20, and then it's just really been clear sailing, to use an Annapolitan term here. However, and I'm going to stick with my theme, bonds tend to be just, well, some might refer to it as the rudder in the storm. What's going to help to keep things, keep this boat level? That's where bonds come in. So the question on the slide, how much higher can Treasury yields go? We think they're going to go higher, but we don't think they're going to just all of a sudden start ratcheting up. Another important observation of what is taking place right now is that the Fed and bond yields seem to be pretty much in tandem. What the bond market is telling us and what the Fed is signaling are pretty simpatico. I can think back to the days of Alan Greenspan, and it was anyone's guess what was going to happen with interest rates. Alan and his other Fed people, they'd go into their meetings and nothing was telegraphed, nothing was transparent. And my, how things have changed over the last maybe decade. I'm going to say a decade. So we don't have to be looking at, this is just kind of a side funny, it was a little ridiculous. It would be, what did Alan Greenspan's briefcase look like? Did he have papers that were jutting out? Was that going to indicate how much bond yields were going to go up? Kid you not. These are the kind of things that you can still see on CNBC. But back to the discussion at hand. The slide you're looking at speaks volumes. The orange on the screen, dating back to 1993, is showing us intra-year lows. Again, the barometer being the S&P 500. You remember these periods. Let's look at this, 2000. Well, actually, we could even look here. These downward spikes. Some of this was the .com era, and we then move over here. This we refer to still as the 08-09. This was ugly. This is the last recessionary period that lasted. It took us, in some cases, years to get back those downturns. Again, this is what we are looking at here at Blue Heron. What can derail, and how are we going to protect our client assets against, while still participating with the growth that equities offer? Very important. We want both sides of this. We want the growth, but we need to protect. So 08-09, that's that downturn. Fast forward, here we are. This was the COVID March, okay? So dipping down, looking at near 30% downturns. However, what do you see here with the blue? And that is your bond market. That is your fixed income. So yes, I mean, you've got some bouncing around here, but certainly not to the extent of the equities. So equities, you're looking for, or we have experienced, I should say, months that there has been a 28% drawdown in stocks. That does happen. However, on the bond side, what is a bad monthly drawdown? 6%, which has recovered quickly. This is why, even though there's nothing exciting about bonds, other than to me right now, it's why we need to have them in our portfolios, depending on where someone is. If they're working for many more years, they're newly retired, that is going to weigh into what that allocation will look like. But having that place to go in portfolios that can even out the ride and to be our go-to, you're building the assets that you have, your 401k, your IRAs, your Roth IRAs, so that eventually you can use those as a source of income. We need to have a place in portfolios to draw from when things get dicey out there. Now, meanwhile, we need to have stock participation. We need to think in terms of your pie charts. We need a lot of slivers to that pie. And some are going to be going negative, while others are going to be going up real strong. But over the course of time, it evens out and it is an upward trajectory. So again, takeaway here, there's a reason to have bonds. We don't want to be overly weighted in bonds. It's not where we're going to be able to offset that I word, inflation. And what is the best offset to inflation? It is stocks. I'm not going to spend too much time here. It's just a little deeper dive into different types of bonds. Really, you can see here right smack in the middle. If bonds are peaking, it means they're cheap. It means you're being rewarded, as is the case in orange, to take on risk, because in return, you're getting a higher yield payout. But this is where we are right now. It really is not, in our opinion, it doesn't behoove investors to be loading up on high yield because they're not getting rewarded. So if that's the case, then why not be more invested in investment grade, kind of synonymous with safer bonds? So that's the big takeaway here. At Blue Heron, we have not been in a pure high yield bond allocation really for several years. If we want to look for high yield like returns, we'd rather be invested in stock. You saw on the prior slide, there's still a case to be made for bonds in the mix. However, when we're looking for returns, and it's what we saw in 2021, you've got this blended return between your stock allocation, your bond allocation, and then doing that deeper dive into different weightings of the different sectors of the market. So I'm going to wrap up here pretty soon. And you know, for those of you tuning in, I will again, in just a minute, turn a slide over that you can send any questions that you would like to be asking right now. I hope you've been jotting down some, but here's what we are in agreement with regards to the research that we're analyzing, and that is we are continuing to look for stocks outperformance over bonds. We're actually, bonds were in negative territory by and large in 2021. And that comes back to, and I was going to say threat of rising interest rates. It's not a threat. It really at this point is a given. And that's okay. The Fed raises rates, yes, to offset inflation, but also to kind of build up some ammunition if things start getting soft in the economy and we're already at low lows. There's not too many places to go. However, as we saw through 2020, actually going back further than that, these new terms come up. You had bond buybacks. Now we are talking about the tapering of purchases. We're talking about letting some of the federal government's balance sheet just drop off. So that comes back to, again, our theme of passing of the baton. What is the Fed doing? So we are favoring stocks over bonds. We do think that there is going to be continued economic growth to drive that, but there will be headwinds. US stocks over international. International stocks have been more favorably valued than US stocks, but they just haven't had that strong earnings growth that we have here in the domestic stocks and corporations. So we want to participate, and it's kind of like they've been on sale for a while, and at some point we would expect to see developed markets picking up, but we're not going to overload there. So US over international. Cyclical sectors, this is kind of interesting where we are right now. There has been a shift thinking again back to coming out of the recession, thinking about, well, even Zoom, think about, oh, how about Peloton? How about those stay-at-home stocks? They had gangbuster years, Netflix. But what's happening, and as happens, sometimes the market gets a little dramatic on one side of things and then reverts back. But value has overtaken growth in terms of your stock allocations. So our position is we will continue to participate in both. Large value, those of you who follow the markets, you may have heard banks, energy, those stocks had been in 2021 picking up steam. Right now, everything's subjected to this downturn in the market, but we've seen those bigger hits on the growth side. We're not giving up on growth. However, they have reacted more to this rising interest rate environment. Bank loans, here at Blue Heron back in November, we were adding bank loans to our portfolios. And this is the difference between what we can do versus within the 401k world, you have some limitations unless you're going to be a do-it-yourselfer and go and pull some of these levers over in the brokerage link side, for example. But it's important for us to be able to have flexibility, to be able to be nimble in our fixed income allocations. We have been looking at other areas that can hopefully be providing us some positives against this backdrop of rising rates. And as you'll see here, the notation that bank loans are less interest rate sensitive. And then just on the bottom part of this, I did talk about emerging markets. They tend to be more volatile than where we feel is warranted to be right now. And a lot of that question mark is around how China is going to be coming out of this. Defensive sectors, we've talked about that when I mentioned growth value. Long maturity treasuries tend to take that hit in a rising interest rate environment. Don't want to get too much into the weeds here, but it's why we don't want to have long duration on our bond allocation. We tend to want to have that more intermediate to short. And I already did touch on high yield credit. We're just not getting rewarded. And if we are looking for growth, we want to remain in stocks. That's where our tilt will be, unless we're working with very conservative investors, in which case that's where we're pulling in some other tools out of the toolbox that allow us to participate, perhaps some principal protection, and really wanting to see that offset to the inflation. It is here. We do think it will go back down to a degree. And so how are we going to offset the loss of purchasing power when there's too much money in cash, money market, CDs, and those areas are not keeping up with inflation? So that's been a lot of conversation that I've been reminding clients. A couple other areas, I'll just throw these out there. These are questions that we'll get. And I will throw out the warning. It is important, in our opinion, not to be making investment decisions based on politics. It just doesn't work. When we think about different presidents over the past decade plus, whether you were an Obama fan or not, if you make your decisions and you weren't in the market, you miss some upturn. Same thing happened. Trump, you had those who bailed and Trump got elected, markets still were moving. Same thing. Biden was elected last year. If decisions were made to get out of the market, oh my gosh, think about that run up that was missed through 2021. So, we will occasionally have those comments from clients. Here at Blue Heron, Liz and I both, we will claim to be politically agnostic when it comes to assisting you with your investments. So I did want to touch on that. Internationally, geopolitical tensions with Ukraine. Yes, we want to be aware. It seems every couple of years there is something geopolitical that, yes, there's concerns. However, is it disrupting our market? And for the most part, there's always the exception. 2001 was an exception where, that certainly was a catalyst for an economic upheaval. But that in and of itself right now, with the tension with Ukraine, it is not forcing our hand to make any decisions based on that. And again, I want to come back to inflation because that's probably where the loudest volume of questions is. We're keeping a close eye on it, but we believe countering inflation with stock participation is going to be important. And we do not foresee late 70s, early 80s, Jimmy Carter type of inflation happening. So I think that's it. I appreciate everyone's attention, and I welcome lots of disclosures here. I think I mentioned many of those, most of those, and more disclosures and contact information. So yes, thank you for your time. Time is precious, and we appreciate you attending today. On behalf of all of us here at Blue Heron, we thank you, clients who are on, for your trust, for the confidence that you place into the team. For those of you who don't know us well, please feel free to check us out. That's our website. And questions you can direct to Debbie at debbie.schilling@lpl.com. I'll leave that up there for a minute, and our phone number. And again, thank you to Northrop Grumman Federal Credit Union for 2 decades plus of working together. Not sure how that happened so fast, but we're delighted to be there for the Northrop Grumman employees and retirees. So have a great day. Stay healthy. Let's keep our eye on the light at the end of this COVID tunnel, and we look forward to seeing you for another presentation.